Hi, welcome to Finance, Business and Investing. Whether you like it or not, we all transact in the economy. It doesn't matter if we are an employee or an entrepreneur. If we are an artist or we work for charity. Many people don't know how the economy works, and this leads to unnecessary hardship. But there's the good news: in 30 minutes, you can learn how the economy works from Ray Dalio. The economy works like a simple machine, but many people don't understand it or agree on how it works. This has caused a lot of needless economic suffering, so I feel a deep sense of responsibility to share my simple but useful economic template. It's not the norm. It has worked well for me for more than 30 years and has helped me see and avoid the global financial crisis. But let's start. The economy may seem hard to understand. It is easy to understand how it works. It has a few simple parts and a large number of simple transactions that happen over and over again. A zillion times. The main force behind these transactions is the way people are, and they create three main forces that drive the economy. The short-term debt cycle is number 2, and the growth in productivity is number 1. The long-term cycle of debt. We'll look at these three forces and how putting them together makes a good way to track economic changes and figure out what's going on. Now, let's start with the part of economic transactions that is the easiest to understand. A country's economy is just the sum of all the things that people buy and sell. And a transaction is something very easy. You always buy and sell things. When you buy something, you make a transaction, which is when a buyer gives a seller money or credit in exchange for goods, services, or financial assets. Credit spends just like money. So, add up the amount of money and credit that was spent. You could find out how much money was spent. The economy is driven by the total amount of money spent. Just divide the amount spent by the number of items sold to get the price. That's a business deal. It's the building block of the economy. Transactions drive all cycles and forces in an economy. So, if we can figure out how transactions work, we can figure out how the economy works as a whole. A market is a place where people who want to buy and sell the same thing can do so. For example, there are markets for weak things, cars, stocks, and a million other things. All of the transactions that happen in all of the markets make up an economy. If you add up all the money spent and all the things sold in all the markets, you have all the information you need to understand how the economy works. People, businesses, banks, and even the government all make transactions. How I just talked about exchanging money and credit for goods, services, and financial assets. The government is the biggest buyer and seller. It has two important parts: a central government that collects taxes and spends money, and a central bank that is different from other buyers and sellers because it controls the amount of money and credit in the economy. For these same reasons, it does this by changing interest rates and printing new money. See, the central bank is a big part of how credit moves. Pay attention to how credit works. Credit is the most important part of the economy, but it is also the part that people know the least about. It's the most important part because it's the biggest, and most changeable. Just like people go to the market to buy and sell things. So, most lenders want to make more money with their money, and most borrowers want to buy something they can't afford, like a house or a car, or invest in something, like starting a business. Lenders and borrowers can both use credit to get what they want. When someone borrows money, they promise to pay back the amount they borrowed, called the principal, plus an extra amount, called interest. When interest rates are high, people don't borrow as much because it costs a lot. When interest rates are low, people borrow more because it's cheaper to borrow and people promise to pay back the money and lenders believe them. People get credit. Credit can be made out of thin air if two people agree to do it. That looks easy enough. But credit is hard to understand because it has many names. As soon as credit is given, it becomes debt right away. Debt is good for the lender but bad for the borrower in the long run. When the borrower pays back the loan plus interest, the asset and the liability disappear, and the transaction is settled. So why does credit matter so much? Because when a borrower gets credit, he can spend more, and spending is what keeps the economy going. This is because what one person spends is what another earns. Consider it. Every dollar you spend is someone else's income, and every dollar you make has been spent by someone else. So when you spend more, someone else makes more money. When someone's income goes up, lenders are more likely to give them money because they think they can trust them more. A borrower who is creditworthy has two things: the ability to pay back the loan and collateral. If he can't pay back his debt, he will be able to if he makes a lot of money compared to how much he owes. He has valuable things that he can use as collateral and sell. This makes people more likely to give him money. So, a higher income lets you borrow more, which lets you spend more. And since one person's spending is another person's income, this causes more people to borrow money, which leads to even more borrowing, and so on. This self-reinforcing pattern leads to economic growth and is why there are cycles in a transaction. You have to give something to get something, and how much you get depends on how much you produce. Over time, we learn, and the knowledge we gain raises our living standards. This is called productivity growth. People who are creative and work hard tend to raise their productivity and living standards faster than people who are lazy and don't try very hard. However, this isn't always true in the short term. In the long term, productivity is more important than credit, but in the short term, credit is more important than productivity. Productivity growth doesn't change much, so it's not a big cause of economic swings. Instead, debt swings happen in two big cycles because it lets us consume more than we produce when we get it and makes us consume less than we produce when we have to pay it back. The first one takes about 5 to 8 years, while the second one takes about 75 to 100 years. Most people feel the swings, but they don't usually see them as cycles, because they see them every day and week. In this chapter, we'll take a step back and look at how these three big forces affect our lives. As we've already said, the line doesn't move because of how much innovation or hard work there is, but because of how much credit there is. Imagine for a moment that there was no credit in the economy. The only way I could spend more is to make more money, which would mean I had to be more productive and do more work. Since what I spend is someone else's income, the only way for the economy to grow is for people to work harder. When I or anyone else gets more done, the economy grows. If we keep track of the transactions and let this play out, we can see a pattern similar to the productivity growth line. But we have cycles because we borrow. This is not because of rules or laws, but because of how people are and how credit works. Borrowing is just a way to spend money you don't have yet so you can buy something you can't afford. To do this, you have to spend more than you earn. You basically have to borrow money from yourself in the future. When you do this, you set up a time when you'll need to spend less than you earn in order to pay it back. It quickly starts to look like a cycle. Basically, whenever you borrow money, you start a cycle. This is true for both individuals and the economy. This is why it's so important to understand credit. It sets off a series of events that will happen in the future in a way that is mechanical and easy to predict. This is a big difference between credit and money. Money is what you use to pay for things. When you pay cash for a beer at a bar, the transaction is finished right away. But when you buy a beer on credit, it's like starting a bar tier because you're promising to pay later. When you and the bartender work together, you create both an asset and a liability. You just made money out of nothing. When you pay the bill at the end of the night, the asset and the liability go away. The debt is paid off, and the deal is done. Most of what people think of as money is actually credit. The total amount of credit in the US is about $50.3 trillion. Remember that the only way to spend more in an economy without credit is to make more. But in an economy where credit is available, you can also borrow to spend more. Because of this, a credit-based economy has more spending and allows incomes to grow faster than productivity in the short term, but not in the long term. Don't get me wrong, credit isn't always bad or just a cycle of bad things. It's bad when it pays for spending that is too much and can't be paid back. But it's good when it makes good use of resources and brings in money. So you can pay the money back. For example, if you borrow money to buy a big TV, it doesn't bring in any money to help you pay back the loan. But if you borrow money to buy, say, a tractor and that tractor helps you harvest more crops and make more money, you're in a better situation. Then you can pay off your debt and raise your standard of living. In an economy where credit is used, we can watch how it is used and see how it leads to growth. Let's say you make $100,000 a year and don't have any other bills to pay. You have good enough credit to borrow, say, $10,000 on a credit card. So you can spend $100 and $10,000 even though you only make $100,000. This is because the $100 and $10,000 you spend is someone else's income. The person who makes $110,000 and has no debt can borrow $11,000, so he can spend $121,000, even though he has only made $110,000. In this case, his spending is another person's income. By keeping track of the transactions, we can start to see how this process works in a way that keeps building on itself. But keep in mind that borrowing starts cycles, and if the cycle goes up, it has to go down at some point. This starts the cycle of short-term debt. As economic activity goes up, spending keeps going up, and prices start to go up. This is the first phase of the short-term debt cycle. This happens because people are spending more because they have credit, which can be made out of thin air at any time. When spending and income grow faster than the amount of goods being made, prices go up. When prices go up, this is called inflation. The central bank doesn't want too much inflation because it causes problems. When prices go up, it raises interest rates. When interest rates go up, fewer people can afford to borrow money, and the cost of existing debts goes up. Think of this like your credit card payments going up every month. When people borrow less and have to pay back more debt, they have less money left over to spend. So, people spend less, and since one person's spending is another's income, incomes drop, and so on. We call it deflation when people spend less and prices go down. If there is less economic activity, we have a recession. If the recession gets too bad and inflation is no longer a problem, the central bank will lower interest rates to get things going again. With low interest rates, people pay less on their debt, borrow and spend more, and the economy grows again. The economy is like a machine, as you can see. In the short term, spending is limited only by whether or not lenders and borrowers are willing to give and get credit. When credit is easy to get, there is growth in the economy. When it's hard to get credit, there's a recession, and this cycle is mostly controlled by the central bank. The short-term debt cycle usually lasts between 5 and 8 years and has been going on for decades. But keep in mind that the bottom and top of each cycle end with more debt and more growth from the previous cycle. Why? People tend to borrow more and spend more instead of paying back their debts because they have to. Because of this, over long periods of time, the number of deaths rises faster than the number of incomes. This creates a long-term debt cycle. Even though people are getting more debt, lenders are giving out even more credit. Why? Everyone thinks everything is going well. People only care about what's been going on recently, and recently, incomes have been going up, the value of assets has been going up, and the stock market is roaring. It's a big deal. It makes sense to borrow money to buy goods, services, and financial assets. When a lot of people do this, it's called a bubble. So, even though debts have grown, incomes have grown almost as fast to make up for it. The amount of debt compared to income is the debt burden. As long as incomes keep going up, the amount of debt is manageable. At the same time, the prices of assets go up because people borrow a lot of money to buy them as investments. This makes their prices go up even more. People think they are rich. Even though borrowers have a lot of debt, rising incomes and asset values help them stay creditworthy for a long time. However, this can't go on forever, and it doesn't. Over decades, debt loads slowly grow, making debt payments bigger and bigger. At some point, people's debt payments start to grow faster than their incomes, which forces them to spend less. And since one person's spending is another person's income, incomes start to go down. This makes people less creditworthy, which makes them less likely to borrow. As debt repayments keep going up, spending goes down even more, and the cycle starts to turn around. This is the long-term debt peak. The United States, Europe, and much of the rest of the world now have too much debt. This happened in 2008. It also happened in Japan in 1989 and in the United States in 1929 for the same reason. Now that the economy is getting worse, people are spending less and making less money. When credit goes away, asset prices go down, banks get squeezed, the stock market crashes, social tensions rise, and the whole thing starts to feed on itself in the opposite direction. As borrowers' incomes go down and their debt payments go up, they get squeezed. If they are no longer creditworthy, they can't borrow enough money to pay their debts, so they have to sell assets to make up the difference. As spending goes down, people rush to sell assets, which floods the market. This is when the stock market crashes, the housing market goes down, and banks have trouble. As the prices of assets go down, so does the value of the collateral that borrowers can put up. This makes people who borrow money even less creditworthy and makes them feel poor. Credit disappears quickly, people spend less, make less money, have less wealth, less credit, borrow less, and so on. It's a never-ending cycle. This seems like a recession, but interest rates can't be lowered to save the day. When there is a recession, lowering interest rates makes people more likely to borrow. But when people are paying off debt, lowering interest rates doesn't help, because rates are already low and will soon reach 0%. So the pleasure is over. During the deleveraging of the 1930s and again in 2008, interest rates in the US hit 0%. The difference between a recession and a deleveraging is that in a deleveraging, borrowers' debt loads have simply gotten too big and can't be eased by lowering interest rates. Lenders realize that debts have become too big to ever be fully paid back, borrowers have lost the ability to pay back, and their collateral has lost value. They can't move because of the debt. They don't even want more people to stop borrowing, and stop getting loans. Think of the economy as someone who can't get credit, just like a person. So what should you do? Deleveraging, the problem is that people have too much debt, and they need to pay it off. There are 4 ways for this to happen, from people, businesses, and governments cutting their spending to defaults and restructurings that lower debts. 3. Wealth is moved from those who have it to those who don't. And lastly, the central bank makes new money by printing it. All deleveragings in modern history have gone these 4 ways. Most of the time, spending cuts come first. We just saw how people, businesses, and even governments tightened their belts and cut spending to pay down their debt. This is called austerity by many people. When people stop taking on new debts and start paying down the ones they already have. You might think that cutting spending would make the debt load lighter, but because one person's spending is another person's income, incomes fall. Since incomes fall faster than debts are paid off, the debt load actually gets bigger. As we've seen, cutting back on spending hurts the economy and forces businesses to cut costs, which means fewer jobs and a higher unemployment rate. This means that the next step is to pay down debts. Many borrowers can't pay back their loans, and the debts of a borrower are an asset for a lender. When a borrower doesn't pay back the bank, people worry that the bank won't be able to pay them back, so they take their money out of the bank quickly. People, businesses, and banks stop paying their debts, which puts pressure on banks. A depression is a severe drop in the economy. People finding out that a lot of what they thought was true is a big part of the depression. Their money doesn't really exist. Let's go back to the bar. When you bought a beer and put it on the tab, you promised to pay the bartender back. The bartender got something good out of your promise. But if you break your promise, don't pay him back, and don't pay your bar tab, the asset he has is basically worthless. Many lenders don't want their assets to go away, so they agree to debt restructuring. Debt restructuring means that lenders get paid back less, over a longer time period, or at a lower interest rate than was originally agreed. When a contract is broken in a way that reduces debt, lenders would rather have a little bit of something than nothing at all. Even though debt goes away, debt restructuring makes income and asset values go away faster, so the debt burden keeps getting worse. Like cutting spending, paying down debt is painful and causes deflation. All of this hurts the central government because fewer jobs and lower incomes mean that the government gets less money in taxes. At the same time, it has to spend more because the unemployment rate has gone up. Many people who are out of work don't have enough money saved and need help from the government. To make up for the drop in the economy, governments also come up with stimulus plans and spend more money. In a deleveraging, the government's budget deficits balloon because they spend more money than they get in taxes. This is what's going on when you hear about the budget deficit in the news. To pay for their deficits, governments need to either raise taxes or borrow money, but with incomes falling and so many people out of work, where are the rich going to get the money? Governments need more money, right? Since most of the wealth is in the hands of a small number of people, governments naturally raise taxes on the wealthy. This redistributes wealth in the economy from the haves to the have-nots. The have-nots, who are suffering, start to resent the haves. The haves, who are being squeezed by a weak economy, falling asset prices, and higher taxes, start to resent the haves. If the depression lasts, social disorder can happen. In the 1930s, this led to Hitler's rise to power, war in Europe, and the Great Depression in the United States. As the depression gets worse, pressure grows in the United States to do something to end it. Don't forget that most of what people thought was cash was really credit. So when people can't borrow money, they don't have enough money. People need money very badly. And you know who can print money? The central bank, which has already cut its interest rates to almost nothing. It has no choice but to make money. Unlike cutting spending, getting rid of debt, and redistributing wealth, printing money causes inflation and makes the economy grow. Inevitably, the central bank creates new money out of thin air and uses it to buy financial assets and government bonds. During the Great Depression and again in 2008, when the Federal Reserve printed more than $2 trillion, this happened in the United States. There are other central banks around the world that could print a lot of money to buy financial assets. With this money, asset prices go up, making people more creditworthy. But this only helps people who already have money. The central bank can only buy financial assets with the money it prints. On the other hand, the central government can buy goods and services and give people money, but it can't print money. So, to get the economy going again, the two must work together to buy government bonds. The central bank basically lends money to the government, which lets it run a deficit and spend more on goods and services, through programs like unemployment benefits and stimulus plans. This makes more money for people and more debt for the government. But it will lower the total amount of debt in the economy. Now is a very dangerous time. Policymakers have to find a good balance between the four ways that debt can be paid off. To keep things stable, the ways that cause inflation need to balance out the ways that cause deflation. There can be a beautiful deleveraging if everything is in the right place. You see, a deleveraging could be ugly or pretty. How can it be beautiful to deleverage even though it's a hard thing to do? It's beautiful to handle a hard thing in the best way possible. A lot more beautiful than the debt-fueled, out-of-control excesses of the leveraging phase. In a beautiful deleveraging, debts decline relative to income. The real economy is growing, and inflation is not an issue. Finding the right balance is the key. To keep the economy and society stable, it's important to find the right mix of cutting spending, paying down debt, transferring wealth, and printing money. People ask if printing more money will make inflation go up. It won't if it's used to make up for falling credit. Remember that what matters is how much you spend. A dollar spent with cash or credit has the same effect on price as a dollar spent with cash. By printing money, the central bank can increase the amount of money to make up for the loss of credit and turn things around. The central bank needs to do more than just boost income growth. It also needs to make sure that the rate of income growth is higher than the rate of interest on the debt. So, what do I mean when I say that? I mean that income needs to grow faster than debt. For example, let's say that a country that is trying to get out of debt has a debt-to-income ratio of 100%. That means that the amount of debt it has is the same as the amount of money the whole country makes in a year. Now, think about how much interest that debt will cost you. Let's say it's 2%. If the interest rate is 2% and your income is only going up by about 1%, you will never be able to pay off your debt. You need to print enough money so that the growth rate of income is higher than the interest rate. But printing money could be used in bad ways because it's so easy and people like it better than other options. The key is to not print too much money and cause inflation that is too high, like Germany did when it got out of debt in the 1920s. If policymakers find the right balance, deleveraging isn't so dramatic. Growth is slow, but debt loads go down. That's a great way to get rid of leverage. When incomes start to go up, borrowers start to look more creditworthy, and when borrowers look more creditworthy, lenders start lending money again, debt loads start to go down, and eventually the economy starts to grow again. This is the reflation phase of the long-term debt cycle. Even though the deleveraging process can be awful if it isn't done right, if it is done right, it will eventually solve the problem. It takes about a decade or more for the economy to get back to normal when debt loads go down. That's why it's called a lost decade. To wrap up, the economy is a bit more complicated than this template shows. But putting the short-term debt cycle on top of the long-term debt cycle and then putting both of them on top of the productivity growth line gives a pretty good idea of where we've been, where we are now, and where we're probably going. So, to sum up, I'd like you to remember 3 general rules. First, don't let your debt grow faster than your income, because your debt will eventually crush you. Second, don't let your income grow faster than your productivity, or you'll lose your edge in the market. And third, do everything you can to improve your productivity, because that's what matters most in the long run. This is simple advice for you and for the people who make policy. Most people, including most policymakers, don't pay enough attention to this, which might surprise you. This template has worked for me, and I hope it will work for you too. Thank you.